This video will help you understand if setting up a cash balance plan is right for you and your business. If you don't know who I am, my name is Chris Dime. I'm a certified financial planner out of Edmonds, Washington, and I specialize in working with folks to and through retirement. One of the most common issues that our higher earning income clients run into is the ability to take tax deductions that materially have an impact on their financial situation. Most of our self-employed clients know that they could set up a 401k plan, which would allow them to take some sizable tax deductions on both the personal payroll side as well as on the business P&L side. And if they have employees, it's a great retention vehicle to motivate talent or make sure that you're doing contributions to their retirement plan for them. The problem with these plans, like 401ks and SEP IRAs, for example, is that they have a cap at around $60,000, which changes each year. It kind of goes up with inflation. But for a number of our clients, a 401k and a SEP IRA isn't enough to meet their saving requirements. For those clients who need something a little bit more expansive than a 401k or a SEP IRA to save enough to get them towards their retirement goals, we look into other retirement plans, and one of them is called a cash balance plan. So rather than getting into the specifics of cash balance plans just all by myself, I had the chance to sit down with Kevin Abrahams over at Definiti, which is a third-party administrator, and I figured he would do a much better job sharing pros and cons, some of the benefits of these programs, who it might be a good fit for, and just some general things to understand before embarking on setting one of these up. Kevin is actually an actuary over at Definiti, which means other than knowing everything there's to know about numbers, he's definitely better positioned than me to talk about these plans and how they're actually implemented. So without further ado, here's my talk with Kevin. Okay, so Kevin, glad we have you on the call today. I guess for our audience, do you mind sharing just high-level overview? Who are you and who is Definiti and how can you help people?
My name is Kevin Abrams. I work for Definiti. I'm a enrolled actuary. I've been in the retirement plan business for about 14 years now, since summer 2009. I've worked for some big multinational corporations handling big billion-dollar pension plans, kind of both ends of the spectrum when it comes to retirement plan work. And then I found myself at Definiti in late 2018. So we're a third-party administrator, which means we handle the day-to-day administration of your typical retirement plan, which would include a 401k profit sharing plan, which is generally the most common type of plan, qualified retirement plan that you'll see. And that administration includes determining on a given year, when we do these annual evaluations and testing, if you're an employer that sponsors one of these plans, we do calculations of how much contributions need to go to your employees to be compliant within testing, as well as, the bonus. One of the bonuses of having these plans is that you get a tax deduction or a tax deferral, for the amount of money that you put in there. So we do that. There's government forms that have to be submitted annually. And so we get that for our clients. We work with, retirees to get payments out of the retirement plans when someone leaves the company and wants to roll their money over to the IRA. So that's basically the general rundown of what a third-party administrator, TPA, does.
Yeah, because outside of just like the large tax deductions, or at least tax deferral that can come with setting up, retirement plans for self-employed folks or larger entities. Also, it's a great retention package for employees. It's pretty competitive out there.
Yeah, and one of the most commonplace types of retirement plans that you see it goes towards employee rewards, retention purposes, is the pension plan. The pension plan has kind of ebbed and flowed over the course of time. As far as popularity goes, because there's regulations involved, there's inherent risk when you set up a pension plan, but there's also, as we'll talk about in the next few minutes, there's plenty of pluses in addition to some of these risks for setting up some of these pension plans.
Yeah, I suppose we could take this call in a number of different ways, but I guess one of the primary things I wanted to make sure we could get your 2 cents and expertise on was those folks who are maybe self-employed, or maybe they work at a pretty executive level in their current company, and we'll just say the 401k isn't cutting it. Maybe they want to save more than the 401k will let them. And so one thing that we've done in the past is introduce the concept of a cash balance plan to clients. Can you riff for a little bit on, how that's efficacious and maybe some of the pros and cons of setting up a cash balance plan?
Yeah, in our world, a lot of these terms are used interchangeably. So when I say pension plan, when I say defined benefit plan, those are used interchangeably. Like I said, a cash balance plan a type of defined benefit plan, a type of pension plan that is very commonplace these days. There's many reasons why the cash balance plan, which I'll get into the details of how those work, why those have kind of replaced the traditional defined benefit plan that has been in place in some of these larger companies for decades now. The traditional defined benefit plan says, when you retire, you can get $100 a month paid for by the company through this plan from your retirement date until you retire. Cash balance plan is the same type of plan, but it's spelled out differently, and they're a little easier to interpret. Also, to add to the list of names that these are called, the IRS actually defines them or classifies them as hybrid plans. But when you look at how a cash balance plan works, you can understand that it's a hybrid plan because it has all the rules and governances of a defined benefit plan, which includes certain funding requirements and compliance testing. But it also has the aspects of a 401k profit sharing plan because the benefit is defined in the form of a balance. So if you look, you're in a cash balance plan, you call your employer up, and I want to know, how much benefit do I have in this plan, is defined as a balance like you would when you check your 401k plan. And so, and cash balance plans, one of the reasons that they may be attractive for people in our, in our industry is because, like you said, you have a 401k plan, you have a profit sharing plan. After a certain point, a lot of the times you get capped out. And when I say capped out, I mean on an annual basis. The IRS defines how much you can put into a plan or how much can be put into a plan on your behalf. In many cases, that's ample, and that's a wonderful opportunity. And Definiti offers 401k profit sharing plans if those meet your goals. And that's obviously, Chris, I know you work with plenty of those. A cash balance plan essentially just increases the size of the retirement benefit that you can accrue, rather than being limited to 61,000 or 66,000 in this year profit sharing plan. The amount that you as an employer can put in to a cash balance plan, which is very helpful for tax purposes, as well as the amount that you could theoretically pull out of the cash balance plan upon your retirement down the road, it makes the 401k and profit sharing plans potentially pale in comparison. There are also limits that apply to defined benefit plans, to cash balance plans.
Okay.
But because of the actuarial nature, there's other things that I won't bore you with because they're a little high concept, and I'll have to get my calculator out.
Sure.
But the bottom line is the presence of a cash balance plan allows for a much higher tax deferral for an employer, and then down the road, like I said, you could potentially be able to roll out, depending on how long you have the plan, your income levels throughout the life of the plan, and several other factors. There's the opportunity to roll out several $1 million of your own benefit out of the cash balance plan into an IRA or another retirement vehicle once you finish with one of these cash balance plans.
So maybe help me understand that. So in my experience with cash balance plans, once somebody's reached sort of those 401k contribution limits, which are, in the 60,000s, once somebody's reached those limits and they're interested in setting up a cash balance plan, is there a number that I should be telling them, like, hey, you could probably fund XYZ amount in addition to the 401k into this bucket?
So what Definiti will do, we'll ask you to, just provide us with, your company information, the census of employees that you have, and, certain demographic information. Depending on what your goals are, which sometimes the goal is just, I want to be able to put in as much as I can, or sometimes the employer will have a specific target contribution in mind that we're usually able to achieve. We will put together a plan design that projects not only for the first year, because obviously the first year is the only knowable year as far as what we can project. But we also try to give a forecast for future years as far as what you might be able to put into the plan, as well as, like I said, down the road, here's potentially what the money could grow to as far as the plan liabilities are concerned. And here's what you might be able to take out down the road. The highlights there are, of course, that you are able, like you said, to get more of a contribution into one of these plans than you would in a 401k plan. In these cash balance plan, there's actuarial work involved. And actuarial calculations involve ages and life expectancies and all these kind of boring things that we put off to the side, but that are underlying in our calculations. So it's age weighted when we do these plan designs. So if you are a plan sponsor or prospective plan sponsor for one of these plans that's in their mid 50s, closer to retirement, you might have different contribution opportunities than 30-year-old Chris over here. And so generally the prospect that comes to us that finds the best cash balance plan design is someone that, like I said, is a few years older than you and me, and they're in their 40s and 50s that are a little closer to retirement age, that have a consistent or expected consistent income each year, to be able to provide for all these contributions and takes the tax deferral off that taxable income.
If I'm understanding correctly, let's say somebody's maxing out a 401k and they've got room to grow to save into a cash balance plan. Is there any sort of benchmark of, hey, the maximum you'll be able to put into a cash balance plan? Let's say you're in your 50s, making $1 million or $2 million. The maximum is 10 grand a year, or is it much higher than that?
Yeah. So if let's say you just you set up one of these cash balance plans on top of your 401k plan, and in this case, I'm just speaking a sole proprietor or a sole business person that doesn't have employees, because I'm just focused on you as the business owner. In your example, you're in your mid 50s and you're making ample income, in the hundreds of thousands up over 7 figures, like you're referring to. There's an opportunity for you to be able to put in $200,000-$300,000 into the cash balance plan annually, which is obviously a leg up compared to what you have been doing in the 60 to 65,000 range in the 401k plan.
And is all that tax deductible to the business as like a business expense? Or?
Yes, that is all tax deductible, which is obviously something that makes it attractive to some of these business owners that we work with every day.
Yeah, especially if maybe they're taking a pretty big distribution from the business, but they forecast retiring in 10, 15 years or whatever. We could set up the cash balance. I say you guys could set up the cash balance plan to be funded at a pretty significant degree over those next few years, and then do some sort of actuarial, wizardry on the back end, whereby once they do retire, it sounds like they can start taking distributions out or rollovers. How does that work? How do people get money out of the plan, I suppose?
So when we get to the end of the plan, and here I'm speaking specifically for the business owner again, but we can look at both situations. I'm a business owner and I've put as much as I want into the plan and I'm ready to shut it down, or I'm just retiring and obviously the plan cannot continue without its plan sponsor, so it's time to shut the plan down.
Okay.
We'll look at everything that's accrued to date as far as the amount that the employer has put into the plan. We do a lot of paperwork things, which of course the wizardry, as you put it.
We'll leave that aside for right now.
But what we basically do, we help facilitate along with you, Chris, for the client. We prepare benefit election forms, they fill them out, and they can roll their benefit from the cash balance plan just like they would in a 401k plan. They can roll it from the qualified plan into an IRA, into if they they go to work somewhere else, they close their business, will go to work somewhere else as a 401k plan. You can roll your benefits, at a 1-to-1 ratio, directly to one of these other vehicles. No taxes involved there because it goes from qualified to qualified. And at that point, we close the plan in this theoretical situation. The plan is terminated. We roll all the benefits out to the employer, to the principal, as well as any employees that are also owed benefits. And then we close the plan down. And then at that point, the money is in this case, theoretically, your IRA, and you have more freedom as far as what you can do with it. You can take things out. We don't handle IRAs here, but that's generally the idea.
And so I guess if the plan is getting shut down, they can do a plan-to-plan rollover of some kind, and they'd have the ability to take ad hoc distributions from their IRA at that point. What if, let's say, it's a family-run business and they're making a bunch of money, they're setting up a cash balance plan, they're planning to fund this cash balance plan for a number of years, and then let's say grandpa is getting ready to leave the business, and Junior's kids are going to continue running the business, aka continue the cash balance plan of some kind. Is there any difference in how a grandpa would distribute his portion of the cash balance plan out of the company plan?
Sure. It would kind of follow a similar procedure to what I was just describing. That was kind of like the part two of the description I was talking about earlier, is that there's generally where the the time that the principal, grandpa here, would
Yeah.
take his money, that would be upon plan termination. But in these situations where either the business will continue on and they'll continue sponsoring the plan with some other family members, or just,
Yeah.
hey, I'm an employee of a cash balance plan or a company that sponsors a cash balance plan, I leave and I want to take my money, which I'm permitted to do so. You're not only are you allowed to take your lump sum benefits from a cash balance plan when the plan closes, but if you separate from service, you're
Mhm.
allowed to roll your money out too. Similar to in a 401k plan where I go work for another company, I can roll my 401k from this company to this company.
Okay. That's helpful information because I think one of the biggest concerns that clients have had in the past, and I guess I'll speak more generally to the audience out there, they might have concerns if they do run a business. One of the biggest concerns of setting up a pension plan, also defined benefit plan, like you said earlier, is the concern that when they do retire, they'll be forced to take liquidations, maybe over a schedule that they're not particularly excited about, such as a guaranteed income paid out to them every year once they leave the service. And for some folks, that's attractive because great, I got my Social Security, I got my pension, I'm good to go. But for other folks who might be, graduating to a different position and maybe they don't need the income or whatever, they might not want those forced, distributions out of the account. And it sounds like the cash balance plan comes with some flexibility where they don't have to take mandatory, distributions every year. They're allowed to do more of a gigantic IRA rollover, kind of sounds
Right.
like. Okay.
Yeah, there's in one of the requirements of a defined benefit plan, a cash balance plan is, set by the IRS, is that when someone separates from service, you are as the plan sponsor, you are required to offer them multiple options as far as the form of payment. So
Okay.
in the traditional sense, and even like I said, in the cash balance plan, the default selection is to take it as a monthly annuity, and in different enumerations depending on what you select. But there's always, especially in our cases, we always offer the lump sum factor, and unless there's some one-off kind of unforeseen circumstances that would, the IRS limitations say you can't take a lump sum, which is very few and far between. Whether it's the principal or the employee of the plan sponsor, they will always
Mhm.
have the opportunity to take their benefit in the form of a lump sum, by check, which is a taxable event, or just roll it directly over to an IRA upon separation from service.
Last question for folks that are tuning in, they're probably wondering if a cash balance plan is right for them. And I know we're speaking broadly, and obviously we can't give recommendations over the internet to random people. But one question I'd have is, and you touched on this a little bit earlier, is who would be probably like a really good candidate for considering a cash balance plan? Older, younger, making 300 grand profit or $1 million profit. Maybe help me understand kind of a good profile
Sure.
of someone that might want to consider picking up the phone and giving you guys a call.
Yeah. Well, so the answer is the non-answer, because these plan designs can work for everybody. It just depends on how much bang for your buck you want to get, what your tolerance is for, covering employees versus covering yourself. So
Mm-hmm.
like I said before, we're happy to look at plan designs for any prospective client, whether they're, a late 20s business owner or someone that's much closer to retirement. The most bang for your buck group will be someone that's, I'd say, 10 to 15 years from prospective retirement. That doesn't mean 65 or 62, because everybody has their own story. The idea is that you have substantial taxable income such that basically the 401k profit sharing plan isn't meeting all of your needs. Obviously, it helps
Right.
contribute towards your tax goals, but you still have substantial profit, depending on how your tax entity is.
Mm-hmm.
You have substantial taxable income that you would like to find something to do with. And so one thing that's important is that in a cash balance plan, when you sign up for one of these plans, it's a commitment. And I don't want this to scare people away, but it's of course a risk that needs to be known. So in a 401k plan, I set up a plan for myself and my employees, and I contribute a 5% profit sharing allocation to them every year, or in 2022. And in most cases, the profit sharing plan is self-directed. So, Chris, you're in my plan, and I give you that allocation, and you decide how you want to invest it. And
Mm-hmm.
hopefully it goes up. Sometimes it doesn't.
Right.
And in a 401k profit sharing plan, if you incur losses as the participant, to say it in so many words, too bad, so sad. Obviously,
Right.
that's pretty cold.
The
Um,
risk is borne by the consumer. We'll put it that way.
That's a better way to say it. Yes. So in a defined benefit cash balance plan, the risk is on the employer. And so what I
Hmm.
mean by that is, each year in the cash balance plan, there's liabilities that are accrued for the business owner as well as any employees,
Hmm.
similar to the account balance in a profit sharing plan. But the risk that I'm talking about with a cash balance plan is that if there are market losses, like we saw, pretty much across the board in 2022,
Yeah.
uh, the business owner, the plan sponsor, is more or less on the hook for making up those losses. So we
Hmm.
have benefits promised to employees of $100,000. Okay. And then we put in $100,000 and then the market loses 10%. Well, in a 401k plan, then that $10,000 is just washed away as
Yeah.
investment losses. In a
Yeah.
cash balance plan, the plan sponsor is on the hook for replacing basically what has been lost. And it's not like
Hmm.
all at once you have to fund $10,000 today, the day that you lose these investment. But over time, the employer has to make it up with additional contributions. So that's just something that
Oh, okay.
a good candidate should be aware of, is that, oh, we project that on a given year you'll fund a certain steady amount. That's what we want to design the plan for. But there are years where instead of funding this in its example, funding $100,000 to the plan, you might have to fund 130,000 to offset some losses or
Hmm.
unforeseen activity that's taken place. And then in a similar vein, in the cash balance plan, we are basically targeting a an end result. So
Gotcha.
we're focused on, we're designing this plan now. We're focused on what do we want the assets to grow to in the
Hmm.
future to basically optimize your retirement. And so what we're focused on is, at the end of the day, we want the asset pool to be a certain level. How we get there is more or less, I wouldn't say irrelevant, but my point is, if I'm putting in $100,000 a year and I go to Chris and Chris doubles my money because he's a great investment advisor, the impact that would have on my annual contributions would be that it might reduce what I might contribute in the next couple of years, because these
Gotcha.
investment gains have outweighed what I need to put into the plan as a contribution. What we as Definiti, as the actuaries, keep our eye on, and that's why we are the consultants, because we can look at what's transpired in the market, what turnover you've had at your company. There's all these different factors that go into the determination of the contribution each year. And that's obviously what we talk about when we do our annual valuations, and we determine, here's what you can fund, here's what you should fund, and sometimes those are different amounts.
It sounds like, sort of in the name, cash balance plan. The goal is to accumulate a particular amount of cash balance to meet, XYZ number of commitments you have to your employees of providing them a consistent payout when they retire, theoretically.
Yes,
So, some years, if the market is up, great. That means you, as the business owner, have less you need to make sure goes into the plan because the cash balance is, we'll just call it high for the sake of this example. Whereas if the market doesn't cooperate well and that cash balance goes smaller than was originally anticipated, well, the business owner is on the hook to, fork over enough to
right.
ideally bring that account back to parity within a reasonable time frame. So
Yeah,
there could be lumpy contributions from the employer to the cash balance plan to meet the commitments that have been made to the employees.
exactly.
That right?
Yeah, and that's dealing with some of the volatility I was talking about earlier.
Cool. Okay, so this is super helpful information, Kevin. Thanks for sharing so much. I guess
Great.
we covered some of the risks that go into cash balance plans, some of the positives. We covered, roughly good demographics for folks who might want to be thinking about setting up one of these and reaching out. So I guess as we wrap up, let's say somebody's identified, hey, I'm a good candidate for this. I think this would totally fit in the budget. I like the idea of reducing taxes. I guess what would be their next steps in getting in touch with you guys?
Basically, what you do in 2023, you go to our website. So we're
Okay.
definiti.com, and it's spelled as in on my shirt over here,
Okay.
DEFINITI.com. And at that point, there's, we on our website, we have some information about the different types of plans, including what we just talked about, in
Mm-hmm.
our discussion today.
Mm-hmm.
There is an opportunity for you to reach out and submit some information saying I'm interested in signing up for a plan. And we
Mm-hmm.
have some marketing folks, that are dispersed around the country, depending on what region you are in, and shortly be reaching out to you to kind of give you more information, get some more information from you. And they also help with, quoting and pricing and things like that.
Okay, sounds good, Kevin. Thanks so much. We'll be sure to link your information down below too, so people have a really easy way of getting in touch.
Oh, great.
Appreciate your time today. Thanks so much for joining.
Thanks. I'm glad that we got a chance to talk. Thanks, Chris.
Totally. Talk to you later. Bye.
Bye.
So hopefully you found that helpful in understanding a little bit more about cash balance plans and how they might be a good fit for you. Of course, if you have questions, don't hesitate to drop them in the comments or get in touch on the website. And if you want to bypass me and just go speak directly to somebody at Definiti, I'll drop all that information down below and you can click some links and go from there. Hopefully that was helpful. Have an awesome rest of your week. We'll chat with you later. Bye.